with BlackRock, which is the world's largest investment management firm. It had $4.4 trillion of assets under management as of March the 31st, 2016.
Astonishing. You know, it attracts enormous inflows because it's got a big passive index tracking business, but it is the world's largest. So we're setting the scene by talking about, you know, the globe's largest player in terms of aggregate assets under management.
Market cap, yeah?
Excuse me, that's outside perhaps of a couple of sovereign wealth funds, you know, which are linked to governments.
Thanks for that clarification. Market cap, we're looking at $59.5 billion US, a P of 18.9, dividend yield of 2.6%. How does BlackRock rate in your opinion, Rowan?
Yeah, this has now become really the big gorilla in asset management, and so big that with its index funds, it's becoming such a big shareholder in a number of different companies, and it's actually running into antitrust issues, if you can believe it. It owns big shareholdings in a number of banks.
So size is starting to count against it.
Yeah, well, it's just getting complex from a regulatory point of view, but I think it's in the sweet spot in terms of we're seeing quite a big move towards ETFs. To some extent, investors are getting a little bit disillusioned with active managers and their inability to add alpha and value, especially after fees, and the default is becoming these so-called exchange traded funds, tracker funds, and that's where they are, and hence good inflows, and the share are close to record highs.
Well, there we go. Generally, people getting, as Rowan has said, a little bit cautious and perhaps disappointed with active managers and their ability to add value and alpha, as Rowan has put it.
Absolutely,
and
that's
that goes
quite
back
a
to
telling observation. So the big three in index trackers in the US are Vanguard, which is privately held, that's Jack Bogle's outfit, Fidelity, and then BlackRock, which owns iShares. Remember a couple of weeks ago I said that Barclays had done a number of missteps in recent years, and one of them was to sell a business called iShares to BlackRock. So those inflows are because people in their pension funds in America are choosing the index tracking option rather than putting it with a hedge fund or with some, you know, high
It goes back to that old discussion on passive versus active. Anyway, let's not go into that discussion now.
Well, I think it's a good discussion to go into, but what it, I guess, tells you, if you're in the index tracking business, that's the part of the index you want to be. That's where the investment flows are going to be. That's where the fees are going to be earned, even though they're low fees.
Shall we call BlackRock hot or not?
Almost a 50% share in
I
ETFs.
think we have the share chart.
Oh, do we have the share chart?
Been warned. Yeah, there you go.
Yeah,
that looks a lot like the index, a lot like the S&P's chart, doesn't it, Rowan?
Yeah, I guess you could argue that these things are a bit of a sort of a geared investment to the market. Obviously, when the market's going well, they're earning performance fees and good asset management fees. The base is growing, and vice versa when the market's not doing that well. So it is a proxy for the market.
On that note, are you ready to call it?
Yes.
As a proxy for the market, hot or not? Hot
well,
not?
I don't know. I'm positive about the market outlook. We have actually owned this stock before. So I think I'm going to tip it hot, just simply because I don't want to undermine my own position about where the equity market's going. But this one is quite cyclical, so whether you want to replicate the market in your portfolio is not always clear. But yes, hot. Sorry.